Alright, we're going to be talking about cost of capital. Basically, we're looking at the sources of finance and their relative costs. Alright, so when we're preparing our balance sheet, on the right side or the liability side of the balance sheet, we have debt, we have preferred stock, and we have common equity. These are normally referred to as the capital components of the firm. Okay, so in the balance sheet, we've got the asset side and the liability side. On the liability side, that is where we have our debt, that is where we have our equity, that is where we have our preferred stock. Any increase in the firm's total assets will have to be financed through an increase in at least one of these capital accounts. Alright, so if our assets are increasing, which means that this is financed by an increase in either debt, either preferred stock, or common equity. The cost of each of these components is called the component cost of capital. So we start by looking at the cost of debt. So cost of debt, it is also known as KD. KD represents cost of debt. So this is the rate at which the firm can issue new debt. This is the yield to maturity on existing debt. This is also called the before tax components cost of debt. And then when we have KD in 1 minus T, this is the after tax cost of debt. Here T is the firm's marginal tax rate. The after tax component cost of debt is used to calculate WACC. Alright, so WACC is the weighted average cost of capital. So when we're calculating WACC, we used the after tax component of debt. We don't use KD, we use the after tax component cost of debt. So in many countries, the interest paid on corporate debt is tax deductible. Because we are interested in the after-tax cost of capital, we adjust the cost of debt KD for the firm's marginal tax rate. Okay, that is why we use KD 1 minus T. In tax jurisdictions where interest payments are not deductible for tax purposes, T is 0, and at the pre-tax and after-tax cost of debt is the same. So where in jurisdictions where debt is not tax deductible, or where T is 0, we just use KD. And then we move on to the cost of preferred stock. So the cost of preferred stock, which is also known as KPS, is found by dividing the preferred dividends by the market price of the preferred stock. We move on to the cost of equity. The opportunity cost of equity, which is also known as KCE, is the required rate of return on the firm's common stock. The rationale here is that the firm could avoid part of the cost of common stock outstanding by using retained earnings to buy back shares of its own stock. So the cost, that is the required return on common equity, can be estimated using one of the following 3 approaches. So firstly, you can use the Kappa model. Okay, so under the Kappa model, you first of all have to estimate the risk-free rate. Usually for the risk-free rate, we usually use the TB rate. Okay, the rate on treasury bills or on US treasury notes. Secondly, you have to estimate the stock's beta. This is the stock's risk measure. Okay, so you have to estimate the beta of the stock. Thirdly, you have to estimate the expected rates of return on the market. All right. And then number 4, you use the CAPM equation to estimate the required rate of return. So here we're calculating the cost of equity, okay, which we said it was also known as KCE. So to find KCE, you say that RF, which is the risk-free that you've estimated. We said usually you use the rate for treasury bills plus the beta, open bracket, expected return of the market minus the risk-free rate, which we said usually is the TB rate. So this is how you calculate the cost of equity using the capital asset pricing model. You can also estimate the cost of equity using the dividend discount model approach. If the dividends are expected to grow at a constant rate G, then the current value of the stock is given by the dividend growth model. So the current price of stock will be equal to the dividend, the next year's dividend, which is D1 divided by the required rate of return on common equity, which is KCE, minus G. So rearranging this equation, it gives us KCE, which is the cost of common equity, which is what we are trying to figure out. So the cost of common equity will be equal to D1, which is next year's dividend, divided by PO, which is the current price, plus G. So in order to use the dividend discount model to find the cost of equity, you need to estimate G, that is the growth rate. So to estimate G, you can use the equation G is equals to retention rate multiplied by the return on equity. So the retention rate is also equal to 1 minus the payout ratio. So alternatively, G is equals to 1 minus payout ratio multiplied by the return on equity. So this dividend discount model, the only difficulty in using this model is estimating the growth rate. And then finally, you can use the bond yield plus risk premium approach to calculate the cost of equity. So here the cost of equity will be equal to the bond yield plus the risk premium. And then we move on to calculating the company's weighted average cost of capital. So the company's weighted average cost of capital, which is also known as WACC, it is given by WD. WD stands for the percentage of debt in the capital structure. So we say WD multiplied by the cost of debt, the component cost of debt after tax, plus WPS, which is the percentage of preferred stock in capital structure, multiplied by KPS, which is the cost of preferred stock, plus the weight of common stock multiplied by the cost of common stock. Okay, so this is how you get your weighted average cost of capital. Alright, so for calculating weighted average cost of capital, we use KD 1 minus T, okay, because we said tax is interest deductible. So when you're calculating WACC, we use KD 1 minus T. So this is an example to calculate the weighted average cost of capital. So suppose Dexter target capital structure is as follows. The weight of debt is 0.45, weight of preferred stock is 0.1, weight of common equity is 0.45. Okay, so the weight of all the components of capital structure should equal 1. So if you say 0.45 plus 0.45, 0.9 plus 0.1, we get 1. And it's before tax cost of debt is 7.5, its cost of equity is 11.5, its cost of preferred stock is 9, and its marginal tax rate is 40%. So you can see that we've been given the before tax cost of debt. Okay, so to find the after tax cost of debt, we have to say 7.5% multiplied by 1 minus 0.4. So it's 7.5 times 0.6. Therefore, to find the answer, the work will be equal to 0.45 multiplied by 0.075 times 0.6 plus 0.1 multiplied by 0.09 plus 0.45 multiplied by 0.115, which gives us 8.1%. And lastly, there's an assignment. You have to outline and critically analyze the impact of cost of capital on investment decisions.